Welcome to the Deep Dive. Today we're cutting through the noise of financial reports.
That's right. We're looking at Burlington Stores, Inc.'s second quarter 2025 earnings.
And, crucially, their forward guidance. Our mission.
To unpack what these numbers truly reveal.
About the off-price giant strategy and, well, its future. Let's dive in. So Burlington Stores just dropped their Q2 2025 results, August 28th. And the headlines, they're definitely grabbing attention.
Oh, absolutely. They didn't just meet expectations. They kind of blew past them.
Right. So what, in your view, are the absolute standout figures, the ones that tell the clearest story right off the bat?
Well, what's immediately striking is just the sheer strength across the board.
Okay.
Total sales surged, 10%. And that's building on a really robust 13% increase from last year.
Wow. Okay.
And here's a key metric for retailers. Comparable store sales. Sales from stores open at least a year, they rose a solid 5%.
5%. And didn't they do that last year too?
Exactly. Remarkably mirroring last year's Q2 performance, which is impressive on its own. But the real insight, for me anyway, comes when we look at their core profitability.
Right, the bottom line. And what do those core profitability numbers reveal?
Well, their reported net income hit $94 million, diluted earnings per share at $1.47. Those are good numbers, definitely. But what's truly fascinating, and I think critical for understanding Burlington's underlying health, are the adjusted figures.
Adjusted figures, okay. What are they adjusting for?
These numbers strip out specific sort of non-recurring expenses, things tied to bankruptcy-acquired leases. It gives us a much clearer, cleaner view of their ongoing operations.
Got it. So operationally.
Operationally, their adjusted EBIT margin, that's earnings before interest and taxes, a key measure of operational profit, it shot up a remarkable 120 basis points.
Hold on. 120 basis points. That's a full 1.2% improvement in margin, right?
Exactly. A significant jump. And adjusted EPS, earnings per share, climbed an incredible 39% to $1.72.
39%.
Yeah. This isn't just about good numbers. It's a powerful signal. It shows Burlington's core business model is not only resilient, but becoming significantly more efficient at turning sales into actual profit.
So what does that mean competitively? Especially when you see other retailers maybe struggling with margins.
That's the key question, isn't it? It suggests a real strengthening of their competitive edge.
That's a crucial observation. And the CEO, Michael O'Sullivan, he called this an exceptional performance and a high-quality earnings beat. Sounds confident?
Extremely confident. And he pointed to several internal drivers behind that confidence.
Like what?
Things like sales coming in ahead of their own plans, a higher merchandise margin, lower freight expense, and what they call leverage on SG&A selling general and administrative expenses.
Leverage, meaning their costs didn't scale up as fast as their sales.
Precisely. Their fixed-like costs aren't growing as fast as sales, so each new dollar of revenue becomes more profitable. It really speaks to operational discipline. And what's more, he explicitly links these strong results directly to their ongoing Burlington 2.0 strategies.
Burlington 2.0.
Yeah.
Right, that's been their focus for a while now. So these aren't just one-off wins. They're seeing a real return on those strategic initiatives.
That's exactly the implication. He emphasized that these strategies are still in their, quote, early stages of their potential impact.
Interesting. So more to come, potentially.
It suggests we're seeing the foundational shifts they've implemented starting to really bear fruit, driving not just a good quarter, but maybe setting the stage for longer-term sustainable performance. It makes a compelling case that this isn't just luck, it's strategy in action.
That long-term vision certainly seems to be paying off in the headlines. But let's dig into the nuts and bolts a bit for those who love the details. How exactly did they achieve those impressive sales and margin figures? What levers did they actually pull this quarter?
Okay, yeah, let's get into the mechanics. Total sales for the quarter hit $2.7 billion, that 10% jump we mentioned.
Right.
But let's zoom in on the margins, because like you said, this is where Burlington really shined. Their gross margin rate, the profit after the cost of goods, jumped significantly. It hit 43.7% of net sales. That's nearly a full percentage point higher than last year.
A full point. Wow.
Yeah.
And what fueled that big jump? Was it just one thing?
No, it was a combination. Merchandise margin, so the profit from the actual goods they sold, expanded by 60 basis points.
Okay.
This was mainly because of lower shortage, that's basically inventory lost from theft or damage, and also smarter reductions in markdowns.
So less lost product, better pricing discipline.
Exactly. Think about it. Less lost product and smarter pricing on what they do sell. And on top of that, their freight expense, which is a huge cost for any retailer, improved by 30 basis points as a percentage of net sales.
Okay, so that shows a real grip on both buying and supply chain efficiency.
Absolutely. It's a powerful mix.
Buying better, losing less, marking down less, and shipping more efficiently. That's quite a list. What about those SG&A expenses you mentioned earlier? Did they creep up?
Well, even the reported SG&A at 35.2% of net sales remained largely flat. But here's the crucial part. When you look at the adjusted SG&A, it actually improved as a percentage of net sales. It ticked down slightly from 27.0% last year to 26.7% this year.
So their growth isn't coming at the expense of rising overhead.
Correct. They're growing with increasing efficiency, really leveraging their operational scale, as they say.
And how did all these operational improvements flow through to adjusted EBIT and EBITDA? Those are numbers investors watch closely, right?
Oh, definitely. And those operational improvements created a clear ripple effect. Adjusted EBIT, again, on that adjusted basis, surged to $162 million. That's up from $118 million last year.
Big job.
Yeah, and its margin increased by that impressive 120 basis points as a percentage of sales. Similarly, adjusted EBITDA, another key cash flow indicator, also increased by 120 basis points as a percentage of sales. It hit $257 million compared to $205 million last year.
So those adjusted figures really highlight the core operational strength.
They really do. They underscore that Burlington's core operations are just generating more profit from each dollar of sales. It reflects real discipline in their, unique buying and selling model.
Okay, so moving beyond just Q2, how did the first 6 months of fiscal 2025 shape up overall for Burlington? Was this quarter an isolated splash, or is it part of a stronger tide?
It definitely looks more like a consistent trend. For the first half of the fiscal year, total sales increased a solid 8%.
8% for the half. Okay.
And net income saw a substantial jump too, up 28% to $195 million, or 3.05 cents per share.
28% jump in net income.
Yep. And on that adjusted basis we keep coming back to, adjusted net income climbed to $217 million, or 3.3 to 9 per share. So no, this quarter's success wasn't a fluke. It seems to be building on a foundation of pretty consistent performance improvement.
This brings up a really interesting point for an off-price retailer like Burlington. Inventory management. It's so different from traditional retail, right? They thrive on opportunistic buying.
Oh, absolutely. It's central to their model.
So what do the numbers tell us about their inventory strategy right now?
This raises a very important question, and it's where you really see Burlington's strategic agility shine. Now listen to this. While their total merchandise inventories were up 16% year over year, hitting about $1.4 billion.
Okay, up 16%. That sounds like a lot.
It does initially, but here's the crucial detail. Comparable store inventories, the inventory in existing stores actually decreased 8%.
Decreased. Okay, so they're not just piling up excess stock in the stores.
Exactly. They're keeping store inventory lean. But what's truly powerful, strategically, is their reserve inventory. That grew significantly, from 41% of total inventory last year to a full 50% this year.
50% in reserve. Half their inventory isn't even in the stores yet. What does that signify for their off-price model?
Well, this shift to 50% reserve inventory isn't just a number. It's like a strategic superpower for an off-price retailer.
A superpower? How so?
It means they're not forced to buy constantly just to fill shelves. They're choosing to buy strategically when the deals are exceptionally good. They can grab high-quality merchandise at significant discounts, often when other retailers are maybe struggling or overstocked.
So it insulates them from market volatility.
Precisely. It insulates them from the volatility that can really crush traditional retailers who have to plan buys months in advance. This allows Burlington to capitalize on those unexpected opportunities. It's like having a really deep bench of players ready to step in whenever the game shifts. Pure flexibility.
That makes a lot of sense. It sounds like they've positioned themselves really well for those opportunistic buys.
Mm-hmm.
Now, just quickly, what about their overall financial footing? How liquid are they, and what's their debt situation look like?
Their liquidity position looks very robust. They're standing at nearly $1.7 billion.
Right.
That's made up of about $748 million in cash and another $946 million available through their ABL facility. That's basically a flexible line of credit.
And jet.
In terms of debt, their total outstanding debt was around $2.04 billion. They're also showing confidence in their own stock, by the way.
Oh, no.
They repurchased $26 million worth of their common stock during the quarter, and they still have a substantial $632 million remaining on their share repurchase authorization.
Okay, so buying back their own shares.
Right. It all paints a picture of a company with strong financial health, which obviously supports their operational success and those strategic growth initiatives, like the new stores.
Okay, so we've covered a fantastic Q2, a solid first half driven by operational efficiency, smart inventory plays. But what does Burlington expect for the rest of fiscal year 2025, and specifically the upcoming third quarter? This is often where it gets really interesting, right? Companies balancing that current success with the future outlook.
This is indeed the pivot point, and it is interesting because despite that strong Q2 performance, their full-year guidance reflects a degree of cautious optimism.
Cautious optimism, even after blowing past Q2 expectations.
Yeah. Yes, which is actually a common and often quite smart approach for off-price retailers. They operate in a very dynamic market.
Right. Things can change fast. So what are they projecting for the full year?
For the full fiscal year 2025, they're projecting total sales to increase 7% to 8%. Comparable store sales, though, are expected to increase a more modest 1% to 2%.
Only 1 to 2% comp growth for the year after a strong Q2.
Correct. However, and this is a really key takeaway, their full-year adjusted EPS guidance has been increased. They're now guiding to a range of $9.19 to $9.59 per share.
Okay, wait. They raised the earnings outlook significantly.
Yes, quite significantly compared to the $8.35 they delivered last year on that adjusted basis.
So they're expecting to make more profit even with somewhat moderate sales growth expectations. That seems like a strong signal about their confidence in margins and cost control.
It absolutely is. It signals confidence in their operational execution. They also plan to open approximately 100 net new stores this year, which requires capital about $950 million in expenditures planned.
100 new stores. Still aggressive growth there.
Definitely. An adjusted EBIT margin is still expected to increase between 20 to 40 basis points for the full year. So margin expansion is still planned.
Okay, that's the full year. What about the immediate next quarter, Q3?
Now, when we zoom in on the third quarter 2025 specifically, their outlook is even more conservative on the sales side. Total sales expected to increase 5% to 7%. Comparable store sales growth projected at a much tighter range, 0% to 2%.
0 to 2% comp for Q3, flat to slightly up.
Exactly. Adjusted EPS is guided to be in the range of $1.50 to $1.60. And their adjusted EBIT margin for Q3 is expected to range anywhere from down 20 basis points to flat compared to last year.
Down 20 to flat. So potentially a bit of margin pressure in Q3 compared to last year, even as they expect full-year margin expansion.
Potentially, yes, based on their guidance. It's a fascinating contrast, isn't it? Raising the full-year earnings guidance while maintaining this conservative sales outlook for the near term.
Yeah, it is. And Michael O'Sullivan specifically addressed this, didn't he? He said they are, quote, maintaining our previously issued guidance for 0% to 2% comp growth in the third and fourth quarters, and that they will, quote, manage our business conservatively and be ready to chase. What does that manage conservatively, ready to chase philosophy really mean for their strategy, especially for an off-price giant like Burlington?
Look, that strategy of managing conservatively and being ready to chase is absolutely fundamental to the off-price model. You could almost call it their superpower.
Okay, explain that.
It allows them to capitalize on those opportunistic buying situations we talked about as desirable merchandise becomes available, often unexpectedly. In a retail environment that can shift so rapidly with consumer taste or economic conditions, having that flexibility to chase, meaning to quickly acquire great deals and flow those goods to stores, is a massive competitive advantage.
So the conservative sales forecast gives them room to maneuver.
Exactly. It means they aren't locked into chasing sales at any cost. They can wait for the right deals. And the fact they raised the full-year earnings guidance, even with those cautious quarterly sales comps, suggests a really strong confidence in their ability to manage margins and costs effectively, no matter what the top line does in a single quarter.
So they're basically saying, we expect to extract more profit, maybe even if sales growth moderates a bit, because our operations and buying are strong.
That's essentially the message, yes. They're leveraging their operational strengths and that disciplined inventory approach we discussed.
Okay, so wrapping this up, we've seen a really robust Q2 for Burlington Stores. Solid sales growth, really strong margin expansion, and importantly, a raised full-year earnings outlook.
Definitely strong results.
But at the same time, they're signaling a pretty conservative approach to sales expectations in the coming quarters. It's a fascinating snapshot, really. A company thriving while also planning very strategically for the future, leveraging that unique off-price model.
Yeah, what's fascinating here is that delicate balance they're striking. They're celebrating the current successes, which they link to those Burlington 2.0 initiatives,
Right.
while also strategically preparing for potential shifts, whether it's shifts in consumer behavior or just market opportunities opening up. It feels like it's about building a more resilient and efficient operational model for sustainable growth, not just, riding the wave of one good quarter.
So for you, our listener, this deep dive hopefully highlights how companies like Burlington adapt and strategize in this constantly evolving retail landscape.
Yeah, it really shows the power of operational efficiency and that strategic, agile buying in driving profitability, especially critical for a business model like off-price retail that absolutely relies on seizing those
It
opportunities.
certainly does.
And maybe this raises an important question for you to consider as you think about this. In an off-price market where that agility and opportunistic buying are so key, how much can conservatively managing sales expectations actually be a strategic strength rather than just a sign of caution?
That's a great question. Is it a smart buffer against uncertainty, protecting margins? Or does it maybe signal a subtle slowdown in underlying demand that they're anticipating? Something to think about.
Exactly. Food for thought.
And that is our deep dive into Burlington Stores' latest earnings report. Thank you so much for joining us on this journey of discovery.
Yeah, thanks for tuning in. Keep exploring, keep questioning, and keep learning.